From the following data, calculate national income by output method and income method. Alright, and before we go ahead and do the calculations, I'm going to write down the formula for both the methods. Alright, for the output method, our first step is to calculate something called gross value added at market price, which is equal to the value of output minus the intermediate consumption, which by the way is here and here. Alright, so we do this and we get GVA at NP. Then it normally involves many more sectors. Okay, one time for primary, one time for secondary, one time for tertiary, sometimes it's for multiple firms. Either way, the summation of all the GVA NPs that you're able to calculate gives you GDP at NP. Okay, and once you are here, then you're in a position to reach national income, because national income is nothing but NNP at FC. Okay, and some basic formulae which you should always keep in mind, and I'm going to quickly write them down here. Gross minus depreciation gives you net. Okay, domestic plus NFIA, net factor income from abroad. Do you see it? Net factor income from abroad, is it given to us directly anywhere? Here we go. Net factor income from abroad gives us national. And if we have market price, then we can subtract net indirect taxes in order to get factor cost, or what we call FC. Okay, so for example over here, FC stands for factor cost. Now, going forward, I have GDP MP. I need to move from GDP MP to NNP FC. Okay, so I'm just going to write it below over here, just so that you understand. For gross to become net, I have to subtract depreciation. Okay, so if I am starting with GDP at NP, I need to subtract depreciation. Then, if I want to move from domestic to national, I need to add NFIA. So, I'm going to add net factor income from abroad. And to move from market price to factor cost, I need to subtract NIT. Okay, so we subtract NIT. And by doing all of this, we'll end up with NNPFC. Okay, by doing all of this, we'll end up with NNPFC. So, one more time. NNPFC is equal to GDP MP minus depreciation plus NFIA. Okay, again, you have to be careful, NFIA minus NIT. And now I can just quickly substitute based on the values we calculate. Alright, now I've explained what the output method is. I'm just going to go ahead and do the math for output method, and then we'll have a look at the income method. The value of output, we have 2,500. The intermediate consumption we have as 1,300. So I'm thinking you're going to get GVAMP as 1,200. Okay, and because there is no other GVAMP, the same thing gives us GDP MP. Okay, which is 1,200. And then we can come back down over here and continue by subtracting depreciation. And remember, consumption of fixed capital means depreciation. Okay, depreciation is a reduction in the value of fixed capital or the use of fixed capital. So we subtract 160 there. Then we add NFIA, which is a negative number. So I'm just going to write it like that in brackets, minus 30. Plus minus will give us minus, obviously. Then minus net indirect taxes. And net indirect taxes has a separate formula, okay, which you should know. Okay, and I'm going to do it slightly below here. Net indirect taxes is equal to indirect tax minus subsidy. And our indirect tax is 180. And our subsidy is 40. So we end up with 140. So minus 140. And now we are finally in a position to calculate an NPFC. So finally an NPFC will equal to, it is going to equal to, it will equal 1,200 minus 160 minus 30 minus 140, which gives us 870. So we can say therefore NNPFC is equal to 870 crores. Now this is under the output method we just solved. Now we're going to do the same thing, same form of calculation under the income method. And you need to keep in mind, under the income method we can directly get net domestic product at factor cost, which is the summation of factor incomes, rent plus wages plus interest plus profit, and then depending on the question it can be compensation to employees plus operating surplus plus mixed income, and many sums in the board tend to mix both of these formulae, no problem, we'll also do. Now we are here and we have data on top. We have rent given to us as 110. We have employers' contribution to social security, profit, wages, salaries, interest, mixed income of self-employed. Now the moment you see so many of them, try as far as possible to stick to one of these two formula. Worst case scenario, mix, but try and stick. So if we were to think of a formula, sub-formula for compensation to employees, that would be anything and everything given by the employer to the employee in the form of cash, kind, and contribution to social security. Then, as far as operating surplus is concerned, we have a sub-formula for operating surplus, which is income from property. Income from property plus income from entrepreneurship. And income from property in turn, and I'm just going to do it in short. Income from property is equal to rent plus royalty plus interest. Income from entrepreneurship is nothing but profit, which is equal to dividend plus undistributed profit plus dividend plus undistributed profit plus corporation tax. In this question we don't have to worry so much about the profit component because they have directly given it to us. So as far as income from entrepreneurship is concerned, we have a direct number. So I'm going to solve for operating surplus directly, which is equal to income from property plus income from entrepreneurship. Income from property, we can do a little bit of calculation because rent is given, interest is given. There's no royalty in our question. So how much is rent? Rent is 110 and interest is 10. So 110 plus 10. 110 plus 10 gives us 120, which is our first value here. So 120. Income from entrepreneurship is nothing but profit, and profit is given to us as 50. So plus 50, which gives us 170 as operating surplus. So as far as compensation to employees is concerned, if I squeeze in the calculation there, I have wages and salaries 340. I have wages and salaries 340. There is no kind, but I have contribution to social security employer's contribution, important. If it's employees, ignore it. Employers, you will include. Okay, so wages and salaries 340, employer's contribution 30. So altogether I get 370 as my compensation to employees. So 370 here, operating surplus, I've just done all that math, it is 170. Okay, and mixed income, thankfully, has been given to us directly, 360. Adding all of this, you will get your final answer. Okay, so we have 370. Okay, so 370 plus 170 plus 360, which gives us 900. Okay, so NDPFC gives us 900 crores. And now we need to reach NNPFC. This is national, this is national, this is factor cost, this is factor cost. The only thing we need to worry about is converting domestic to national. And how do we do that? How do we go from domestic to national? By adding NFIA. So NFIA is minus 30. So it's NNPFC is equal to NDPFC plus NFIA, which is equal to 900 plus, and then we in brackets write minus 30. So that's as good as saying 900 minus 30, which is equal to 870 crores. And we know we are correct. Therefore, NNPFC under the income method is equal to 870 crores, which matches what we got under the output method here. Okay, with that we're done.